Today, we're looking at two absolute heavyweights of the financial world, the massive, non-stop Forex market and the ancient, steady presence of gold. Now, they're both titans for sure, but you're about to see they operate on completely different playing fields.
So, here's our game plan. We'll introduce our two titans. Then we'll dive deep into the high-speed world of Forex. After that, we'll explore the timeless allure of gold. And finally, we'll put them head-to-head to really nail down the one thing you need to know about how they both shape our world.
All right, let's get right into it and look at the DNA of these markets. It helps to think of them as having two totally distinct personalities, each with its own way of thinking and acting. And that really gets to the heart of the matter, doesn't it? What's the best way to take the pulse of the global economy? Is it through the constant churning flow of money? Or is it through the quiet, solid stability of gold? You could say one is driven by economic action, while the other is all about human reaction. Okay, let's tackle our first titan, Forex. And it's really no exaggeration to say this is, by far, the biggest and most liquid financial market on the entire planet. So just how big are we talking? Well, on an average day, we're looking at a turnover of over $7 trillion. I mean, to give you an idea of how massive that is, that's like trading the entire yearly economic output of a country like Germany every single day. So what does all that money sloshing around actually mean for you? Well, it all comes down to one word: liquidity. It means you can buy or sell huge amounts almost instantly without the price moving against you. Your orders get filled fast at the price you expect with almost no slippage. You know, that tiny price jump that can happen between the moment you click and the moment the trade executes. It's what makes the markets so efficient. And that efficiency never ever sleeps. The Forex racket is a true 24-hour beast. It literally follows the sun around the globe. Trading kicks off in Sydney, gets past to Tokyo, then moves on to London and then New York before the whole cycle starts right back up again. There's always a market open somewhere. Now, let's talk about one of the most defining features of Forex trading: leverage. In simple terms, it's the ability to control a big pile of money with just a small amount of your own. So, for example, with a pretty standard 1-to-30 leverage, just $1,000 from you could control a $30,000 position. It's a seriously powerful tool. But, and this is a huge but, leverage is a classic double-edged sword. That same power that can supercharge your profits can also supercharge your losses just as fast. This is exactly why managing your risk in Forex isn't just a good idea, it's absolutely crucial. So what is it that actually makes these currencies go up and down? Well, it's basically the heartbeat of the global economy. We're talking about huge macroeconomic factors, like when a central bank decides to change interest rates, or when a big GDP or inflation report comes out. Even things like employment numbers or major geopolitical events can cause huge moves. A currency's value is, in many ways, a report card on its country's economic health.
All right, let's shift gears and turn to our second titan, gold. Now, unlike the fast-paced world of currencies, gold's power comes from something else entirely. It's seen as this ancient, reliable store of value, something humans have prized for thousands of years.
You know, if you had to boil down gold's role in the modern world to just one phrase, this would be it: a safe haven in a storm. When things get chaotic, when markets get choppy and investors get nervous, they tend to run towards what they see as simple, stable, and safe. And very often, that's gold.
One of the most important things to understand about gold is its relationship with the US dollar. Because gold is priced in dollars, they have this inverse relationship. They're like two ends of a seesaw. When the dollar gets stronger, it makes gold more expensive for everyone else, so its price often goes down. And of course, the opposite is true. It's a constant tug of war. And what's really interesting about gold is its dual nature. See, on one hand, it's a monetary asset. Central banks hold tons of it, and investors buy it. But on the other hand, it's also a physical commodity. It's used to make jewelry, it's in our electronics. This means its price is pulled by two different forces: how investors are feeling and real-world demand for the physical stuff. This all feeds into its reputation as a hedge against inflation. Think about it. When the cash in your wallet starts buying less and less because of inflation, people often look for tangible things that hold their value. And since there's a limited supply of gold on Earth, it's long been seen as a way to protect your purchasing power when currencies are weak. Okay, so we've met our contenders. Now it's time for the main event. Let's put these two side by side and see how they stack up in the ultimate showdown: Forex versus gold. Let's break down the biggest differences right here. The
The number one driver for Forex, it's all about macroeconomics and interest rates. For gold, it's much more about emotion, risk, sentiment, and plain old fear. And while both markets have high liquidity, Forex is just on another planet. Then there's leverage, which is way, way higher in the Forex world. The bottom line is they react to totally different things and give you totally different tools.
And that brings us to a point about volatility that might actually surprise you. While currencies are always wiggling around, gold can actually be more volatile. It can have these huge, sharp price spikes, especially when there's a crisis. It might be quiet for ages, and then suddenly, boom, it erupts.
So, after all that, what's the one big takeaway? It's this. We haven't just been comparing two different assets, we've really been comparing two markets with fundamentally different personalities.
And why is that so important? Well, if you walk away with just one thing, let it be this. The Forex market is driven by the economic engine of the world. We're talking data, policy, growth. Gold, on the other hand, is driven by the psychology of the world. Fear, uncertainty, the hunt for safety. The engine versus psychology. If you can grasp that one single distinction, you're well on your way to making sense of global financial news.
And that just leaves us with one last question for you to think about. Now that you understand their fundamental natures, the engine versus the psychology, which of these powerful forces are you going to be watching more closely? Thanks for digging into this with us today.